Thanks for watching this session of the 2024 Housing Oregon Conference. We're a growing organization of over 120 members working to strengthen affordable housing in Oregon. If you found this helpful, smash that like button and hit subscribe for more updates. Slide decks and handouts are linked below. Together, we amplify the voices of developers, owners, and renters across the state. Visit housingoregon.org to learn more or to support our mission.
Hello, everyone. Can you hear me? Yeah? Okay, great. Well, our moderator, Jilian Saurage-Felton, is on I-5. But as soon as she gets here, she'll take over. Let me introduce myself. I'm Kathy Swift of Heritage Bank, and I'm also the president of the Pacific Northwest chapter of the Women's Affordable Housing Network. And all of my panelists here are also members of the Pacific Northwest chapter of the Women's Affordable Housing Network. I want to encourage all women to belong. We are free and we're fun. So our happy hours are the best. But we also do education and mentorship. In fact, Aubrey, why don't you stand up? Here is our first intern from PSU, Aubrey Giles, and this is her first day as intern. So she is going to be fulfilling an important role of collecting up any questions you have. I mean, this is a senior lender forum or discussion. If you have questions, you don't feel like, you want everybody to know it's you who's asking, don't worry, just write it down, give it to her. She will bring it up. We intend to have fun because those of you who know some of us know that we are a little irreverent and we don't take ourselves too seriously. So on the other hand, we're in very serious times and we're in hard times. I know because I talk to all of you, and we've got to keep the hope and keep going. And hopefully what this session will do for you is kind of give you what the heck senior lenders are thinking about. Okay, so let's first start by introducing everyone. Again, Kathy Swift, Heritage Bank, been doing affordable housing lending for a long time. Next.
Hi, I'm Rachel Morey-Bidu. I'm with the Network for Oregon Affordable Housing, and we're a not-for-profit permanent lender.
My name is Gina Leone. I'm the Affordable Housing Director for Umpqua Bank. Also have been doing this for many decades, which is fun.
My name is Shana Daby. I am a originator for Greystone. We are primarily known for having the main licenses in Fannie, Freddie, and HUD, and we also have a bridge platform and a newly formed tax credit syndication group.
Great. Next, I am going to be quizzing you. How many folks here are nonprofit developers, sponsors of affordable housing? Raise your hands. Good. Excellent. How many folks are developers, consultant roles? Okay, excellent. How many folks are in either asset management, property management, or, in the trenches, working on keeping it going? Excellent. I'm glad you're here because that's going to be an important thing we'll talk about. And then how many lenders? Woohoo! So you guys want to know what lenders are thinking, huh? I might have to ask some of you what you're thinking. Okay, so let's get started. The first question, what is wrong with you bankers? Why are you not lending? Let's get started.
I've signed up for that question, so.
Oh, Jillian's here. Jillian, we should have you re-ask the question the first question as you asked it of us yesterday, because it was pretty pricey.
Hi, my name is Jilian Saurage-Felton. I'm the housing director at Community Partners for Affordable Housing. Again, thank you for your patience. Why are you guys so mean to us?
So I'm going to try to tackle that. Really, your banker's not trying to be mean to you. We genuinely care about the project, what's happening in our communities, and unfortunately, we are regulated. And so as a federally regulated institution, we have to comply with certain rules that make us ask lots of questions and really kind of dig into the nitty-gritty of your project and your financials and all sorts of stuff. So I'm going to start at like the 30,000 foot level about banking. And then I'm going to drill down into what we call the 5 C's. So just general banking structure. You guys probably already know this, but just kind of to level set everything, how a bank works. We take deposits. We take those deposits and other sources, and we make loans. It's like you have to balance that equation. So always thinking about if we're taking deposits, we're holding client deposits, but then we're also helping our clients by making loans. So if you're taking deposits and you're making loans, it's super, super important that your loans are going to be repaid. So keep that in the back of your mind. Now we're going to go back to 5 C's, the 5 C's of credit. When you choose to become a banker, which I bet if I asked all of our panelists, how many of us chose to be bankers? Like we woke up and said, my dream is to be a banker. No, none of us. It just doesn't happen. You kind of fall into this space. But when you become a banker, the very first thing you learn about is the 5 C's. These are, it's a framework to assess creditworthiness and potential risk in a deal. And it helps us to manage risk. Bankers talk about risk a lot. The 5 C's are character, capacity, capital, collateral, and conditions. I think all of these are super important, but if I had to choose one, character, that is number one. That criteria is really about what is the client's credit history, what's their experience, what's their track record for performance, repaying debt on time, credit score, background checks, have there been bankruptcies, foreclosures? We analyze all of that to really try to understand who are we working with, because we're going to be a partner for a very long time. So once we've kind of done that analysis, then we start digging into capacity. This is the financial capacity of the sponsor. What kind of cash flow do they have? What kind of liquidity do they have? What kind of projects are they working on or are in their existing portfolio that might be a draw on their cash flow or liquidity that could potentially impair repayment of our loan? The third criteria is capital, and this is the borrower's equity in the project. Affordable deals are a little bit different because a lot of that equity is coming from low-income housing tax credits. Are we okay? Okay, boo. So we've analyzed all those funding sources really closely to understand what's the timing, what are the conditions for those sources to make sure that the capital stack will work for the project. Fourth criteria is collateral. So we're looking at where is the project located? What's the loan to value? What's the cash flow? What are the future needs of that project? And then lastly are conditions. In this category, we're looking at what's happening in the kind of micro and macroeconomic environment that could potentially impact the project. And so to the terms of the loan will be structured to try to minimize risk around those market conditions. So those 5 C's kind of are the premise of, I mean, we end up preparing a credit request for a transaction that can sometimes be 20 to 60 pages long. And it's really talking about all of those characteristics, the 5 C's. So
we're not trying to be mean. That's kind of what we're thinking about. And there's a lot of regulatory oversight to make sure that we're accounting for all of those characteristics.
And I will add that in our heyday of low-income housing financing, when interest rates were going down and inflation was non-existent, and before COVID, we really focused on the project. And I think that that trained a lot of sponsors and development folks to also be focused on the project. If the project numbers work, if the pro forma works, then we're all okay. What do you mean you need to understand my cash flows as a consolidated entity? What do you mean you're worried about that 6 of my 12 properties have a below 1.25 or 1.1 debt service coverage? What do you mean that you are concerned that our liquidity, our cash balances have gone from, this many million down to this many million? These are questions that didn't have to be asked before, but because of the conditions of the industry and because of the inflation we experience, because of a whole lot of factors, banks really do have to take the strength of the sponsor to a far greater degree of analysis than we ever did before. And I as a lender, what I see is I still come when I'm talking to the development staff who are working on a project in their pipeline, and they are not getting it when I'm saying, no, I got to understand the big picture. They're like, no, my pro forma works. What do you mean? And it's a big deal right now until we get through this period of uncertainty. So.
Yeah, I think when our conversation, when we were talking about these questions, one of the things we talked about is one of the reasons that it's becoming more and more important that the sponsor is strong is because the way the LIHTC system is set up puts so much risk on the sponsor, right? We have debt service coverage covenants, we've got ODG, we've got construction loan guarantees, all of that comes back to the sponsor. So then if the sponsor isn't strong or the bank feels that it's a risk that they won't be able to cover those losses, then it becomes an issue. Speaking of risk, one of the other things that we had talked about is what's a watch list? My banker told me I might end up on the watch list, and I don't know what that means. Can you tell us a little bit, panel, what about how organizations are risk rated, how deals are risk rated, and what are criticized assets?
Thanks. Okay, so a watch list is a list that we have of all of the loans that are not hitting the benchmarks that we have set forth, either in the loan documents or per our internal policy. Really good ways of getting on the watch list are below expected operations, particularly below either, depending on what institution you're working with, either DCR of either 120, 115, 110 to 1, or for sure you're getting on the watch list if you're below break even, which is 1-to-1 ratio.
Even if payments are current.
Even if payments are current. In addition, we look at occupancy a lot, physical occupancy and economic occupancy. And we're looking at if there are a lot of abnormal, out of the ordinary incidences at the property. If there are construction defects, if there are big capital projects that need to be completed, so the physical condition of the building. And then especially right now, we are looking at sponsor strength. And we don't just look at all of these things individually. This is a big picture thing that we look at. You know, there are individual points that can get a loan on the watch list, but generally, we're looking at big picture, and that is how a loan gets on the watch list. Now, the way a loan can get off of the watch list is really a combination of things. So first of all, we want to see that the property is operating and that we're not worried about repayment. One other thing, you will definitely get on the watch list if you don't repay. If you miss a payment, you're on the watch list.
Criticize
Yeah. Yes. And there are also different levels on the watch list, depending on every institution rates their loans differently. But like, for example, if you have a number system and your loan is a 1, that means everything's great. If it's a 2, it's like, oh, let's keep an eye on it. And if you're lower than a 2, there's different levels of scrutiny that we're going to be looking at. Okay, so getting off the watch list. Number one thing, property is operating well. We're seeing that income is supporting expenses, that debt payment is going to be made, that there is a consistent way of operating that is going to be stable for the long term. Also looking at occupancy, like I mentioned before, but also in terms of sponsor strength, you can get off the watch list when your organization is experiencing turmoil. It's harder, but it's possible. But the main thing is what Gina was saying about character. It is really, really important to communicate with your lender. If you communicate early, if there's an issue at the property and you know it's going to be flagged in the future, tell your lender up front. Because a lot of times, if I have a loan that's on the watch list and I'm taking another loan to my credit committee to suggest that we lend more funds for a different project, I can go to them and I can say, there are X number of loans on the watch list with this sponsor. However, they come to me every single time and they tell me, oh, there's been a fire, or we're not hitting occupancy, so our operations are suffering, and this is what we're doing about it. The worst thing is getting the reporting, doing the analysis, and then having to reach out and say, hey, what's going on with the property? If you're telling me up front, it's a really good way of showing that the character aspect of things is strong and much more likely to lead to favorable lending in the future.
So we touched a little bit at the beginning on the decline in lending and the more strict credit standards that have existed. So I was just going to speak a little bit about how business ebbs and flows between regional banks, national banks, and then the space that I sit in, which is more of the government-sponsored entity space. So pre-pandemic, the agencies did about the 54% of all multifamily originations, and I'm not speaking just affordable, I'm speaking globally for multifamily. And then the regional banks in 2022 stepped up pretty mightily, debt funds as well, so that volume declined. And then you've had the phenomenon with the Silicon Valley Bank, Signature Bank having to mark down to market the assets on their books. And so the role of the GSEs is to fill liquidity and become a source of continued liquidity in the multifamily market. So back in 2023, our share rate increased from 39% in 2022 during the aggressive lending cycle by banks to 58% when the banks fell out. So at the same time, there's increased scrutiny on property performance and property condition and attention to fraud, which goes to the character, and more investigation of the sponsor on the front end. So we used to be able to, in the heyday, submit a pro forma, a rent roll, a model, not have to supply a full REO analysis, and that those times are no more. So to get really quality feedback from Fannie or Freddie or HUD, you have to provide a lot more information at the outset. On the ongoing rating system process, or we're regulated by the Federal Housing Finance Agency. And there are, I'm just going to use round numbers, 25 lenders that have the direct licenses for Fannie, Freddie, and HUD. And so it's a top-down approach to regulation where our servicing team has a rating scale. And I'll just use some rough terminology, but it's all kind of the same concept, I think, that overlaps to different financials. So if you miss submitting financial statements, for example, on time, then you might be on a pass or watch. If you've got some more weaknesses identified, but you haven't experienced a decline in occupancy or a major decline in rents, you might be a special mention. And then once you start to have those issues, like there's warning signs that you may be unable to make your debt service or properly maintain the property, then you would be moved to a substandard. And then the worst place to be, as was alluded to, is delinquency or default. So if you default under your loan documents or you don't make your loan payment, then you're going to get a lot more calls and letters from the servicing staff. And then I would also add that your ratings can affect what latitude and freedom you have for things like waiving insurance deductibles, for being able to draw down from the reserve account to be able to approve repairs. So staying in compliance and having a favorable rating gives you more freedom as a borrower as well.
I wanted to tie this back to Jillian's initial question, like, why are bankers so mean? I mean, all of this is just so, it ties to, we're federally regulated. It's safety and soundness, right? So if you have a project that's troubled in any of the reasons that the panelists have described, and you are increasing the risk on a loan and the risk rating is deteriorating, banks are required to hold more reserves because there's a greater potential for an issue on that loan. We are required to do that. So as you move up these steps, more and more reserves have to be held. And that's why even if payments are being made, this is the most common comment that I hear when we're talking about particularly debt service cover fails. But our payments are still current, and we're like, keep doing that. That's awesome. We don't, because we're going to get in danger zone if you don't do that. But there is a financial impact to the bank as these loans deteriorate over time, which is why you're getting that increased scrutiny, all the extra questions, the detailed action plans, because we want to understand what are the real issues and what are the real things that can be done to improve the project performance. And we understand that that may not be something that can occur overnight or a month or sometimes even a year or two. But if the action plan is well thought out and we can see, okay, there's hope at the end of this tunnel that we can turn this around, and you have good character, you've got team members here that are going to be with you right along the way to help make that recovery possible. If those kinds of things don't happen, it makes it harder, and the loan could potentially be transferred into a different department.
called special assets, or it has a variety of names, but generally special assets. They have a very different objective. We are your partners. Their objective is to make the loan be paid off and go away. You don't want to go in that. You want to avoid that at all cost.
I will also add that, as Gina was saying, when an asset is downgraded, the bank or financial institution must hold on to additional liquidity. And that, especially for either small banks or not-for-profits, can really eat into the pot of money that's available for lending. So the greater number of watch list loans we have, the actual amount of funds that we have available for lending has decreased. So it's not necessarily just that we don't want to lend, it's that sometimes we can't. I mean, I'm sure most of you have heard, or a lot of you have heard, at NOAA, we do a lot of smaller size loans, and we're not doing, $20 million loans. That's just not what we're set up for. But theoretically, at some point we might be able to, but if we have a lot of deals on the watch list, that's just not possible. So, yeah, it's important.
I have done 2 times through working in the special assets department. So I take a little bit of umbrage at Gina. I will say that when you become a criticized credit, that the bank's attitude has to shift to protecting the bank's interests. Where we can help the nonprofit to make it through, that's great. Or the project to stay with this sponsor, that's great. But our first responsibility is to our shareholders and our bank to keep to minimize our loss. And unfortunately, in this world of affordable housing, everything has been dialed up to 11 during the last few years, where everybody stretched because we all wanted to get new units out there, because we all know the crisis is huge. And so much more than 10 years ago, the deals are coming in at admission way tighter and with less room for error, or less room for the unexpected. And guess what? COVID was unexpected. And we'll be talking about it more in tomorrow's lunch. But really, we have a lot to work through still. And so us as banks, you as sponsors, we got a hard row ahead of us. So we're going to get through it. I have every part of my fiber, every fiber tells me that. And we will have creativity, but we're also going to have to do a heck of a lot of advocating. Oh, by the way, I swear a lot now. And so if something comes out, I'm sorry. It's my reality. I almost had it.
That comes from the special asset days, I think. Yeah. But to be fair, I think we all refer to that as, Kathy's dark time when she was in special assets. It was not Kathy's happy time. Before we move on to the next question, I just want to tie together some threads. And there's some terminology that we use in affordable housing and banking that has multiple meanings. So Gina, you mentioned the bank needing to hold more reserves. I want to clarify that means that the bank can't lend their deposits, not that the property needs more reserves. Sometimes the property having more cash can make up for a low debt service covenant, right? We're talking about cash flow, we're talking about cash on hand, and these things can be balanced. But I just wanted to be clear to everyone who's not a banker that when we're talking about bank reserves, we're talking about the deposits, the actual physical dollars that the bank has that they cannot lend out. And so that ties into what Rachel was saying, that the more credits that you have on the watch list, the more deposits you have to hold, the more cash you need on hand in order to make sure that you can pay off your depositors, right? A higher risk loan means that there's a higher likelihood that that deposit that you lent out is not going to get repaid. Oh, there's a phone ringing. It's probably mine. So I want to get a little bit wonky. I know, a little bit. What, Jillian? Because we're getting a little wonky in here, and I want to talk about some things that have happened in the last couple of years that probably all of us have read about, but maybe we haven't quite synthesized what the impact of these news events have had on our ability to get loans as developers and banks' ability to lend the money. So the ongoing impacts I want to talk about specifically are two things that were unrelated but happened about the same time, and they were like two pebbles being thrown in a lake at the same time, where the ripples have joined together and become much bigger ripples than either one of these things alone, despite the fact that they're not related. So one is the failure of Silicon Valley Bank, and the other is the failure of Skid Row Housing Trust. If you're not familiar, Silicon Valley Bank was a regional bank that had a lot of concentration in certain markets that went under, and the FDIC had to come in. Skid Row Housing Trust was a very large permanent supportive housing developer and holder of units in Southern California. And they both failed. And those have had pretty big, like I said, ripple effects throughout the market and have started changing underwriting criteria. Starting with Gina, can you talk a little bit about how that has affected your bank's thinking about lending and risk?
I'm going to start again with a preamble. Sorry, that's kind of my style. The world that we live in is very small. So even though the two examples that Jillian's provided are in California, which is kind of our backyard, but not really, it is. So our executives, our chief credit officer, our regulators are all aware of those situations that happened in California. And as a result, they're going to ask us questions. Well, what's happening in your portfolio? Where are your concentrations? You're going to see increased audits, kind of querying our portfolio to see, well, how do things look? Even though there was nothing prior to those two events that would ever have maybe triggered additional questioning, because those events happened, all of us have probably experienced this. It's like the increased scrutiny just goes through the roof. Because there's concern that maybe there could be additional stress in the banking system that's unidentified. I'm happy to report we made it through those just fine. So concentrations is something that I think we talk about more at all levels of the bank. There's federal restrictions about how much we can lend in certain areas, and we manage to that pretty tightly, and that will continue to be the case. But there's also diversification just in who your client base is. So again, this is kind of the higher level, kind of bringing it down to affordable housing. We're going to look at concentrations within our existing affordable housing portfolio. Do we have too much PSH? Do we have too much mixed use, too much rural, too much urban? We, as a large community bank, like to have diversification anyway, because we're trying to serve our urban and rural populations. But I think there's just a lot more thought that goes into this than was historically the case as a result of these two events. Let me see what else I had in my note. We're also evaluating projects that are having a little bit more stress. Really digging into operating expenses and trying to understand what kind of themes are we seeing. Obviously, increases in insurance expense, utilities have really had a negative impact almost across the board, across the whole footprint. and across all projects. So that's something that we're looking at closely. And when we go to underwrite a new transaction, we're going to be asking upfront, like, have you, client, inquired or queried your insurance carrier to really understand what the costs are going to be for a new policy? And we may not have asked that question early on. We're going to ask that very early because those costs are so high. They're having material impacts on operations. So I know we have lots of questions, but maybe I'll pass it to.
Sure, I can. So NOAA is in a kind of unique situation where we have member banks that provide funds for a pool. And then from that pool, we lend, which reduces the risk share for each of the banks for each of our loans. So when you're coming to us for a loan, we generally have to operate like any of the regulated banks because we're getting our money from the regulated banks in most cases. So in addition to what Gina was saying, we're really drilling down on the sponsor analysis and we're asking questions that we wouldn't have asked in the past. Like what operating deficit guarantees do you have, obligations do you have in terms of construction guarantees and ongoing operating deficit guarantees. We're also looking at maturities and rate resets. And those are all things that, you know, some of us might remember from a long time ago, but we haven't been asking about consistently through the years. So when it comes to NOAA, you know, when you're looking at us as a not-for-profit partner, we do have a lot more flexibility in our lending, but we also do get funds from the regulated banks. So, you know, we're looking at the same 5 Cs that everyone else is.
So with the unraveling of Silicon Valley, and then we also had outfall from First Republic, to draw attention to the opportunity that is created, Fannie and Freddie have stepped up a lot more, both to fund deals that perhaps those banks funded the construction of, but no longer wanted to take the permanent loan on their books. And then increasingly, we're seeing Fannie and Freddie be much more aggressive on forward permanent loan commitments. So Greystone is not a balance sheet bank construction lender. We have HUD for construction, and then we can work with other banks and provide the forward permanent loan commitment, and that has worked well. I have several deals that we took over from First Republic Bank perm loan commitments. And then one thing I'd mention is that the agencies, I know that this conference is very heavily LIHTC, but we've been able to convince Fannie and Freddie to be more aggressive on housing choice vouchers. So I work a lot in LA, and there's an oversupply of housing choice vouchers, undersupply of quality landlords that accept them. So there's kind of a new business model where groups are building low basis, nice units, and then filling them with vouchers, and they may have a plethora of restrictions imposed by the city, such as, you know, a transit-oriented or density bonus incentive, and then layered on with the California welfare tax exemption. And the agencies will underwrite a significant amount of overhang. So the point is, where some have pulled out, there is also other players kind of taking up the space.
One thing we didn't talk about was permanent debt on PSH. Do you want me to go there? Okay.
Yeah.
So bank failure bad for everyone, right? And bank failure bad, which is why being good stewards of the deposits, holding more deposits when we have troubled assets is really, really important, because these failures have cascading effects throughout the industry. And And while none of those depositors lost their money, it's a real possibility. And that is really the nightmare scenario of runs on banks, right? And I think we all studied the depression and the big fall in 1929. That's bad. We don't want that. So I want to move on a little bit and talk about our relationship as a developer with our banker. The question is, what should you share with your banker and when? And is there anything you should keep to yourself? And when should you keep it to yourself? And so we spent a lot of time talking about this, and I'm just going to use a real life example of SEPAs. We were heading towards conversion and could not convert 100% PSH property because we could not hit our occupancy. The timing of it, we could not hit it. And so we reached out to our bank, which happened to be Umpqua, really early to start working through what are we going to do. And we had so many conversations over many months that were very frustrating. But really, I think coming to the table and saying, hey, I think this is going to be a problem. Let's figure out how we do it. Let's push on credit. Let's see what we can do. Really meant that we converted. If we had tried to hide that or not been communicative, I think we still wouldn't be converted. And so that's just an example of be open and share early problems that you're seeing. On the flip side, if you're going to be at 94% occupancy because someone died and you're in a unit 2 days before conversion, shut up. Don't share that. Nobody cares at that point. Like, just, you have no idea. So I think we're kind of agree, like those kinds of things that are immaterial and last minute, not a big deal. If it's a material impact on the property operations, you got to share that. And so we're just kind of popcorn this. I want to start with Gina, since I was just talking about you. What else do you share with your banker, and when do you not share?
This is such a good question. And it comes back to the 5 C's with character. So I would always lean towards pick up the phone. Do it old-fashioned style. Don't send an email. Pick up the phone and have a conversation with your banker. Frequently on LIHTC deals, I believe that this happens a lot with your investor. Please do not forget about your lender. Pick up the phone and have a conversation. The sooner that we understand what's happening, and I'll use an example of a fire, because I cannot tell you how many times we get calls 5 or 6 months later, and it's like, oh yeah, because we have to call the client and say, why is your occupancy dropped? That's kind of weird. And they're like, oh yeah, 6 months ago, 10 units went down because of a fire. And it's like, and you didn't call us? Pick up the phone and talk to your lender, because it has kind of a ripple effect. Number one, it has an impact on occupancy. So we're seeing that trend. So we're starting to think, geez, do I need to downgrade this credit? Secondly, I have to go tell a credit officer, this credit's, like the vacancy's off. And the first thing they're going to say is, why? If I have to say that vacancy is off because there was a fire 6 months ago and 10 units went down and I didn't know about it, I look like an idiot. If I look bad, you guys look bad. And I that's a very harsh statement, and it's not said selfishly. It's said with love. When we work together, when we understand what's happening, we can prep our team and say, hey, this client that has great character called me because last night 10 units caught on fire and we're going to have units down. And they're like, okay, what can we do to help? Maybe we can even tap into some financial resources to help if we know. Please, please, please call your lender and have a conversation. It's super, super important. To Jillian's point, though, there are some things that we don't want to know about. You have a great example with someone passes away and it's okay. We'll talk about it next month. But if it's going to have a material impact on the operations of the project, if there is fraud, if there's, trying to think of some of the bigger examples. Anyway, Call your lender. That's the message. If you can take one thing away from today, call your lender, have the conversation. And then most likely, oh, that's it. Thank you. The other one that we frequently get is, oh yeah, we changed our property manager like 6 months ago because of some concern. First of all, usually the construction loan agreement or construction term loan agreement will have a provision that you have to notice us if there's a change in the property management. So this automatically creates an issue because you changed it and we didn't get approval. We have to actually do a credit action to get approval for that. So if you're thinking, gosh, there's some issues happening in our property, we think this might be tied to the property manager, pick up your phone and just have a 10-minute call with your lender to let them know, I have this concern. This is what I'm doing to address it. This is who would like to propose to replace. How do you guys feel about that? Awesome. We're going to go get credit approval. It's takes no time at all. I don't think it's ever not been approved. So it's not a problem. But there are steps that we have to go through to make sure that we're in compliance. We're all in compliance with the loan documents because ultimately that's what governs what we can and can't do. I think that's all. Anyone else want to? Yes.
One that we want to know is if there is senior leadership change. Not only because it's the signers on deals and checking accounts and the like, but also, you know, that character of the 5 Cs. We're buying into the strategy and the tactical strengths of leadership. And so if there's an abrupt change, I'm not talking about the well thought out, retirement that we all deserve at some point. I'm talking about, oh, the board decided to fire the executive director for XYZ. We need a call. It's really important. Yeah.
I think I just want to, 2 things. I want to reach back to fraud. What we're talking about is also, if there's been an incident of fraud at your organization, even a small one, if there's a lawsuit, even a frivolous one, talk about it early, let people know, don't let them discover it with a UCC filing pull. Like that's what we don't want, right? Like share that information. The other piece was, I just wanted to share like part of that story with conversion, is talking to all of the funders on the project. Like Gina said, talking to the investor had to come to the table, and Portland Housing Bureau really came to the table to help us out. And it was those getting everyone in a room, a virtual room, and saying, let's think creatively here. At the end of the day, all of your funders want your project to work. They want it to work. And the construction loan after construction is the riskiest time for the bank. I think that's one thing that we didn't talk about. They want to convert. They really do. That is, having a past due construction loan for an affordable housing project is a huge risk. They want to convert. So talking to your lenders, talking to your funders, getting everyone together, they all want the project to go. If you succeed, they succeed. And I think keeping that in mind when we're talking about communication, that sometimes it feels adversarial, but really we're all on the same team. We all want nonprofits to succeed. We all want these projects to succeed. No one has a financial interest in holding that construction loan hostage. It just doesn't make sense. So one of the things we talked about a little bit is PSH. And occupancy woes. I brought up SEPA's own occupancy woes. So lease up struggles leading to conversion struggles. And there are 2 types of housing that I'm hearing a lot about come up over and over again that are causing problems with occupancy. And I want to take them in 2 different questions. So the first one is the North-Northeast preference policy, and the second one is PSH. And I want to start with that there's a lot of successes. Well, full disclosure, I am on the committee for the North-Northeast Housing Strategy, so I kind of have a bias there. But there's been a lot of successes with the preference policy. There's been a lot of homeownership created. There are a lot of opportunities for Black Portlanders to move back to the neighborhoods that they have historically occupied. If you're unfamiliar with the preference policy, it is a policy by Portland Housing Bureau that gives people the first option to move into a unit in North and Northeast Portland if they have historical ties to that community, with the most points going to people who lost their houses through eminent domain. So it is a small but important step in righting wrongs of the past, where the city of Portland intentionally decimated Black neighborhoods. And so there has been a lot of success. One of the successes is that the policy worked as intended. Most of the occupants of buildings in the preference policy area have predominantly Black occupants. It worked. It worked so well that it's now held up by HUD as an example of what other housing agencies can do to address diversity, equity, and inclusion and justice in their own cities. That said, there have been struggles. And I think if you live in Portland, you've probably heard about them. So let's talk about it. Let's get into it. How could it, rather than saying, well, it's not working, it slows down lease ups, let's get rid of it. What I'd like to talk about is how can it be improved so it's not interfering with operations and lease up. I think we're starting with Kathy on this one.
So, I am a strong believer in tell Portland Housing Bureau and tell everybody else what we need. And then they can try to accommodate. So I have been having lots of conversations with Portland Housing Bureau and they're moving. I mean, there's small nudges. At first, the first few conversations, there's nothing wrong with our process. You know, you're full of baloney, da 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 da. And now there's recognition that there was a problem, that the list did get stale, though some folks will say it wasn't very stale. And by simply doing X, Y, and Z, like putting the number of bedrooms you need into the preference listing is huge, as making it easier for the sponsors to fill vacancies. That wasn't in the first. And there was this really tight bureaucratic process and noticing and everything that just drug everything out and caused, delays of more than 90 days in filling a vacancy. And we all know that math doesn't work. You can't have units vacant for that period. And OHCS gets on your case if you're over 30 days without filling a unit. So you've even got some of the government folks at each other's, not at each other's throats, but in real disagreement. So we are having those conversations. And I think that we will make progress. We are making progress. I see, and I think we've talked about, we got to put the preference policy list tracking back at the sponsor level, and the wait list for units, give more control to the sponsors. It's not saying it doesn't, it's not saying we're getting rid of it. We're not getting rid of the policy, but right now, if it's not working, we need to find a way to make it work and to reduce the number of days for filling a unit. Anybody else?
I'll add that we've seen some successes in lease ups and a lot of challenges in lease ups, but as lenders, what we've learned when we're looking at a property that has a northeast preference policy is that we need to keep those challenges in mind when it comes to the lease up plan. So if you are doing if you do have a deal or you're developing in that area, expect to have conversations around that lease up and conversion, and expect that there will be maybe some different metrics that will be required to be utilized. You know, as unit turns do take longer, so maybe we're going to ask for increase underwritten vacancy. We want to stand up here and say we support the policy. We think it's really important. But we also need to look at the reality of the situation and make sure that we are helping you set the property and operations up for success for the long term.
I'll also add, one of the other things that we're trying to influence is, right now it's a bifurcated, you got 30% units that have support that aren't preference policy, and then you've got the 60% unit of AMI units. We need to be able to go a little bit further down to the 50 and 40 and underwrite to that as well, because market rents right now are not that different than what the 60% rents are. And the implications for the tenant, if they get a little bit more salary and they're above, you know, the 60%, you got to leave. You know, there needs to be a bigger economic reason for them to want to be in these units, and thus that you can fill them. Yep.
And this is where I shamelessly plug the Oregon Affordable Housing Tax Credit.
Thank you.
Utilizing that tax credit reduces interest rate, passes directly through to reducing tenant rents. This is a perfect way to utilize that tax credit.
Yeah, so speaking of the 60% units, I wanted to add, you know, one of the things that we've learned is that this was not enough subsidy per unit, and 60% units didn't do what they were intended to do. I was gonna say what they were supposed to do, but what they were intended to do. And I'll just kick us off with a statistic on this, that 60% rents are too high. Per a PHB study in 2022, the average Black Portland household earns about $3,000 per month, which is a lot closer to a 30% AMI than a 60% AMI. So what we are finding is that there are a lot of Black households that are over income for a 30% unit and under income for a 60% unit. But because of how a lot of our financing is structured, these projects only have 30 and 60% units. And some of the 30% units have been set aside for PSH or have Section 8 vouchers, and therefore outside of the preference policy. And I think that's what Kathy was talking about. So not enough subsidy per unit. And how do we buy that down? I want to put like a little pin in buying that down, because that was maybe our last question, because I do want to talk about the other type of housing that we mentioned that has been very hard recently, which is permanent supportive housing. And as we were talking about Skid Row Housing Trust, or Skid Row Housing Trust, it's really come up under the microscope. In addition, we've seen soaring expenses. You mentioned insurance. Insurance over the last 6 years has tripled. That's a Portland statistic. It's who could predict that? Certainly not at a 3% increase per year in expenses. That's not going to cover it. We've seen issues with lease up and timing on permanent supportive housing units going through multiple systems. So using coordinated access and using vouchers and using LIHTC, it means that these are paperwork on top of paperwork on top of paperwork, which is really hard on residents and hard on operators. And therefore the unit turns are long. So what could this system do? What could coordinated access systems and or jurisdictions do to speed up unit turn and to make permanent supportive housing more underwritable? My follow-up question there too is just, I'll get them all out there. Sorry for the long question. What are you guys looking at more closely, and how can we as developers get ahead of those changes? How can we kind of Can you take a look into your crystal ball and tell us if we got permanent supportive housing projects or projects with PSH in them, what should we be looking at to kind of set us up for a smooth conversion? So what can we do better as like on a systems level? And then what should developers be aware of and looking at before construction is even completed?
I'm going to take question number 2 because that's what's populating my head right now. This is a shout out to all of our asset managers in the room who are actively working these projects. And I think a lot of them are struggling. So for developers that have asset managers, hopefully you do, talk to your asset manager. We didn't even talk about this on the panel, but talk to your asset managers and find out what's actually happening in your existing projects and use that as a guide to your underwriting. It makes sense. I don't think it actually happens, but it totally makes sense. So we're going to be drilling that. We're going to be looking at our portfolios and seeing what are the operating expenses per unit in a PSH project in this market. Okay, are we looking at another one? How does the underwriting that's coming into us look as compared to what we're seeing in the existing portfolio? So that's, we didn't even talk about this in our pre-notes, but I just thought of that one. I'm a big proponent of no perm debt on PSH. Huge fan of that scenario. Sorry. I know. It's really challenging. And I think when you have a project that's struggling and you have a perm loan from a federally regulated agency, group like a bank, we have to make sure that certain things are occurring, that the loan will be repaid. And I think given some of the constraints that Jillian described, it makes it very challenging for that to happen. And this product type is, I think, relatively newer. And so we're all learning together about how can we make this work. And so this is my little kind of a newbie observation. I just don't think permanent debt on a PSH project is a good idea, if it's at all possible. Or if you have it, it should be very, very, very small. I also am a proponent of not having more than maybe 10 or 15% of the project have PSH units, because I think you have a greater proportion of units that have higher incomes that help support the cash flow. And what I've learned from folks on the resident services side is sometimes our PSH tenants have greater success with that kind of balance. So those are some of the things that we're kind of observing, thinking about, talking about internally, and just looking at every deal with a fine-tooth comb. Okay.
Building on what Gina has said, this is one of the areas where I see, and I've done a number of PSH financings, and I concur, not that there's no perm debt, but that the capacity for perm debt is very limited, very small. And also that the developer needs to be talking to the asset manager, because some of those contracts, and everybody pushed back and said, yeah, we need 15-year, contracts to match the LIHTC period, because you can't have PSH pulled, which did actually happen on some of the early projects that I've worked on. And it's very detrimental to the organization, to the sponsor. Admin, there's too much below the line, and you can't have the development person working with with some of the governmental groups to come up with something that works from their perspective that doesn't actually work from the true expense, admin expense of PSH. And, you know, I think that there is some movement now where the rates are going up, but you have to fight for it, and you have to fight for it like all the time. And I don't know that people are. They're not. I'm seeing a different consistency. And then finally, I concur that the most risky of projects are the ones that are all PSH. And I have lent on some of those, and I have perm debt on some of those. So I'm guilty. But I know that those are going to be the huge challenge for the sponsor and probably for the bank too.
Yeah, thanks. Oh, sorry.
I'll also add that, Jillian, you mentioned getting units filled. So I wanted to touch on that a little bit. I think that what we've heard is that relying on third-party organizations to source tenant applications slows down the process a lot. So asset managers in the room, I know you have a lot that you're working with already. So sorry to put something else on your plate, but it's really important that when a tenant notices, even before they move out, you can start getting in touch with that third-party organization that is going to provide you with current applicants. Because what we've been seeing is, you know, units staying vacant months. And, you know, if a tenant is giving a 30-day notice, if you're adding months to that, you're going to have a vacant unit. So start working with your third-party organizations that are providing those applications to you early, and try to form a really good, positive relationship with them. So they like working with you and they want to take your call.
So one green shoot with the agencies is they are more willing to look at master leases than they were before. So if we can establish that a third-party tenant referral, social service provider, agency has creditworthiness backing its funding source, that can be one way to alleviate the pressure at the project. It used to be that a master lease that had a 5-year annual renewal or something like that was a non-starter, but they are increasingly willing to look at that, provided that the funding is strong and the program, you know, has substantiation behind it.
So for any policymakers in the room, I want to just summarize. More money. So what I heard is we need money for more asset managers, and we need more subsidy per unit to make so that we have less debt, because none of these things, higher vacancy rates are great. Higher vacancy rates are only a problem when we didn't underwrite it that way, right? It's only a problem to have 10% vacancy if you were expecting 5% vacancy. It's only a problem to have higher operating costs if you don't have a cushion in there for operating costs. So, but having lower or underwriting a higher vacancy means less debt, means more subsidy. Having more asset managers who are more able and have more time to be deeply involved in these projects means that we need money to pay asset managers, which means we need our properties to cash flow, right? Like all of this is related. So I want to get to, let's say in a magic world, we have money to throw at the problem. One of the things that I've heard is maybe we can get money to come into these projects to buy down the loan, and that will solve the problem. Has anyone talked to you all about your willingness and ability to re-amortize debt? Because not unlike a mortgage, if you make a principal payment, your payment stays the same. So if we paid down our loan by $1 million, that actually doesn't help our cash flow at all. It only decreases the amount of debt on the property. So what is the ability to re-amortize debt? And if you can't, what are some alternatives? And then we do have one audience question I want to get to. We've got about 10 minutes left. So just want to give everyone a heads up, talk fast.
They need to talk to the banks. The banks need to talk with their internal credit and accounting folks. It's not an easy thing, especially if it's a bond. If it's a 4% LIHTC deal with a bond, that is a refinancing event to reamortize. I'm not saying it can't be done. I am saying it is complicated. So it's not just, okay, we've got this chunk of money to pay down the loan, bank do this. And the act of paying down the loan, or the act of paying down the loan is always allowed. But if we change any of the terms, that can trigger what's called a troubled debt restructure. That then sticks on the bank's reported problem loans for the life of the loan. So if you do it early, then for the 15 or 20 years of that loan, it's in this troubled category. It actually, though, I would advocate might be the right way to go, especially if that pay down is sufficient. But everybody's got to be at the table and get agreement. This is not something that's just a simple request. And there needs to be some really honest conversations between bond councils and banks and our regulators that make it okay.
It's a good idea to put on the table, I think. It's not, it could be possible. I think the chances of it being possible would be coupled with other actions that the financing team comes together to help the overall project. If it's just an ask of the bank to do a pay down and reamortize, I can't speak for all banks, but that might be challenging. The bank wants to see that there's kind of a collaborative effort to try to solve whatever's happening that causes the need for this to occur. The other thing I would say is it depends on how the bank locked the rate for the loan. Some banks, it's a very formal process, and you won't see this, but there's an actual contract that's made for that rate lock. And it's for a certain period of time at a certain interest rate. And if it's modified, there's a financial impact to break that. That's outside of a swap or a cap or whatever. It's just a separate contract. Smaller bank might have more flexibility because you don't have that kind of a formal contract with your treasury group. So it will depend kind of on how the bank has structured the original lock, how much flexibility they have internally. You also need to look at your loan documents to see if there's any prepayment premiums that are triggered. Again, larger banks, smaller banks might have flexibility to work with that. So there's lots of things to think about, but it's an option to put on the table. I guess that's what I'd say. Okay, pass.
The other thing is, if you have a property that you know is never going to get off the watch list, is always going to have issues, that's not the only option. There are many options. If you talk to your lender, we have had a lot of different experiences in working with sponsors to improve the situation. Nobody wants a loan on the watch list, us and you. So there are creative solutions. So please get in touch with us. I think that's the bottom line, is that there are many paths we can go down, and it totally depends on who your lender is, how flexible they are, and what kind of flexibility they can offer and what kind of ideas they can offer. So come with questions, come with suggestions. We're here to work with you and to listen.
So we have a few questions and I want to get to them. We've talked a lot about communication and we didn't talk about this ahead of time, but I'm just going to take a quick survey. How many projects have you sent to special assets that were blowing a covenant where the borrower talked to you on a weekly basis? How many have you sent to special assets where you couldn't get a hold of the borrower? Mm-hmm.
If I go back to 2008, the clients that I would call and ask for financials and no response. I mean, after weeks and weeks and weeks of response, there's some very sad, additional sad stories in those stories, but those went straight to special assets. Do not pass go. And in that particular environment, I was no longer allowed to speak to that client. So it changes. Kathy's right. I mean, if you had been a special, I mean, I was a good one. She's a good one. And that's not to say that our special assets managers are bad. They're not, but they have a different role to play. It's different. We are here to create relationship and we want to make loans. They are there to make sure that the bank is protected. They're doing their job, but it's a very different job than what we do. And they do it well. So yeah, communicate with your client because that allows us to keep the transaction in our world longer.
And I'm going to cherry pick these questions. So I apologize to everyone who asked a question if I don't get to your question, but this one is directly what we're talking about. And that is if a sponsor has a project that's under development with you / your bank, which is going well, but the sponsor has another project that's in trouble. What should the sponsor tell you about the other property?
Everything.
Everything. Over communicate.
Yeah. Don't let me read about it and don't let my CEO read about it in the Willamette week.
Same. Yeah. Mic drop. That's perfect.
No one wants to end up in the news. Okay. It's my goal every day. Don't end up in the news. It's okay.
Every project will have a speed bump. It's okay. We know that will happen. Just tell us, because together we can work to find a solution. And we may be seeing things in other projects that you don't have the privy to see, that we can share that knowledge, not confidential information, but like strategies that could be applicable to your deal. So actually having a conversation with your lender, your investor, your partners can be very, very advantageous in the long run.
All right. How are you responding as an industry as projects are seeing unprecedented increases in operating costs, namely insurance, labor, and utilities, that were not contemplated when the pro formas were developed, both in how you view projects and operations, and how are you viewing new applications? Who wants to start?
Getting all the good ones. New underwritings, you have to take all of that into consideration. Again, it goes back to the world is very small. The things that happened in California have an impact on us. The things that are happening in our existing portfolios have an impact on what we're going to do going forward. So you're just going to get a lot more questions early on. I'm going to do a small plug for RFPs. Please do not send out an RFP and give a 2-week turnaround. It's not possible. 4-week turnaround is almost not possible. Please, 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 if you want a quality bid, build in some extra time so we can do the good work. Because my goal, our team's goal is to be able to issue a term sheet that's good that day and on the day that you close. I never, ever want to have to modify something. That takes us doing the good work that we've been trained to do. And that means we have to ask a lot of questions. We ask a lot of questions in the pre-flight stage. And we're going to ask even more as a result of what's happening in our economic environment right now. I'm going to stop there. So keep things moving.
I'll just add, it's not enough to just give me the project information. I got to know as a sponsor how you're doing. So the best thing, and my favorite customers are the ones who are keeping me updated. Yeah, you're one of them. Are keeping me updated on their finances, on their properties, um, so that I know exactly what my sponsor analysis is before I get the RFP request for a project. That's the best way.
Okay, we're a little bit over time. I want to thank everyone once again for your patience with me. Like I said, it was completely foreseeable for understands, but thank you to the panel. And I want to say there was one question in here that was, how did I think it's to me, how did you resolve low occupancy conversion? I'm happy to have a conversation about that. I'm on another panel, but find me at lunch. And I'm happy to chat about how we did that and what was involved in that process and how long it took. So thank you all very much.